Greetings from Arrow Capital. My name is Ted Whitehead, and I'm the portfolio manager of the Exemplar Growth and Income Fund. I'm here today to give you an update as to what's going on in the market. Rather than do a webinar at the beginning of the year, we're choosing to do more timely video updates. So this is the disclaimer page. You can read that on your own at your leisure. So let's get into it. So we're first going to do a quick investment process recap. Then we're going to break down how we believed 2023 played out for us. And lastly, talk about the 2024 update. As you can see in the cartoon, people have been rushing back into the market since October, betting on a rate cut, and that seems to be changing. So first on the process, we still believe the economic cycle exists, and that there are four phases. One where PE expands, and that's when coming out of a recession. Quad 2 is when the Fed begins to hike because growth is overheating. Quad 3 is where inflation is still running hot, but the economy begins to roll over, and then you see PE contraction. And lastly is when Quad 4 is when the Fed eases and both inflation and growth are going down. So the quads break down what asset categories work in specific quads. In Quad 1, you want to be overweight equities and credit, underweight fixed income, overweight tech, consumer discretionary, industrials and healthcare, and underweight utilities, consumer staples, energy, and REITs. I mentioned Quad 1 because that's what it turned out to be for 2023. Although everyone was forecasting a recession at the beginning of last year or sometime during 2023, that never panned out. In more detail, you can see the different names that you could go long or short. So, for example, again, speaking of Quad 1, you'd want to be long high beta, momentum, leverage, secular growth, and shorting possibilities would be low beta, defensive value, dividend yield, and small caps. So as I mentioned last year, as it turned out, it was a Quad 1 every quarter last year. And so you had the Magnificent Seven doing quite well, which are growth stocks. But at the beginning of the year, our model was forecasting a Quad 4. And so that's what we were prepared for. And even as we start this year, it looked like a Quad 4, but the data has actually flipped it to where the first quarter of this year is likely to be a Quad 1 or shallow Quad 4. The data is dynamic and keeps coming out. So if things continue to improve, it will become a Quad 1. And if growth decides to falter, it will go back to a deeper Quad 4. But ultimately, if you look forward, the back half of the year is looking like growth with inflation. So on last year, I broke it down into three parts. The January 1st to March 10th, we prepared for a recession. The fund was up 99 beeps. Then we had the credit event, which was the banks that went bankrupt. And we thought the credit event would play out much longer and would not be readily solved, but we were mistaken, and we didn't change our positioning. But in May of last year, the TSX was down 5%, while the S&P was flat. So not having the exposure to the U.S. was a negative as well. But come the back half of the year, we became more neutral and provided some returns. However, we did finish the year just a little worse than negative 1%. So the main thing we want to point out is why unemployment matters. And we've been sitting around this 3.7% unemployment rate in the U.S. for all of last year, pretty much. And everyone expected this to shoot up. And so what are the negatives with unemployment going up is that the government has to dish out more for unemployment insurance, and they take in less tax revenue. And then on the personal side, people are without funds to fund their debt obligations or or consume. So it's a double negative, both from an individual point of view and the government point of view. And as of yet, we have not seen unemployment spike up. Now, there are two data sets. One is the household survey, which has indicated that unemployment, that's where the unemployment rate comes from, but that jobless rate or the jobs are harder to get. And the other survey has been showing very strong growth. And just last week, the January numbers, the non-farm payrolls grew by 353,000. And that was the number that flipped most strategists who were still kind of negative to positive. So hopefully those employment numbers prove to be correct and the economy is on its way to growing. The Atlanta Fed has put out their estimate for the first quarter, and it's just a bit above 4%, so still very rapid growth. One of the things we watch are the continuing jobless claims, which come out every Thursday. And new numbers came out today, which were right in line with expectations. So a little bit lower than the week before. So again, still no signs of unemployment rising. So what do we see? Why do the video now? We are into February, and this is likely when you get a seasonal pullback. We're not looking for a major pullback, but things are overbought, and there are a few conditions in the market that would suggest it might be at hand. One, staples are outperforming discretionary, healthcare is outperforming energy, the US dollar has been strong, and 10-year US bond yields have not broken above 420, 425. So we think that the conditions out there would suggest a pullback is likely. Other things are insiders are selling at a rapid rate. Semis are extremely overbought, but we do see hope in the future in that in this drawdown or pullback, the sectors that have been leading and likely to lead are infotech, industrials, and financials. And part of the reason they should continue their leading is the spending that being done by the government, where the Build Back Better, Inflation Reduction Act, the CHIPS Act are there to benefit mostly industrials in infotechnology. So again, from this slide, you can see that the market, the S&P 500, is hitting new highs. So that's a breakout after being stagnant or below its old high for almost 2 years. It's typical that it would retest that breakout level. It looks like maybe it did earlier in the year, but it's possible that it could do it again. Referencing the Goldman Sachs tactical flow of funds, they believe the pain trade is now lower, not higher from here. And on the CTAs in the small caps, the flip line has already been hit on the short term. So they are now the short-term sellers of the Russell 2000. For the S&P 500 and NASDAQ, the short, medium, long term have not been hit yet, those levels, but that could be weeks down the road or in the near future. So just to quickly summarize the point of the video is we think volatility will be back. There's likely to be a correction in the next 6 weeks. Likely to hear more election noise this year, but we do expect more of the same from the government spending. And the new term that has been put out there is fiscal dominance, meaning the fiscal spending overwhelmed all the tightening done by the Fed and is generating the growth in the U.S. marketplace. Rate cuts are expected at some point, but as of writing, that's been pushed out from March until May. It could be that gets even pushed out further till the second half, depending on what the growth rate comes in at or how fast it slows down. It's not likely that the Fed will cut rates if the growth rate is over 4%, and even if CPI is 2%, they would still believe that cutting rates would just fuel the fire of that growth. So what we see for this year is more of a balanced approach. And one of the main things we're watching for trouble because of the the amount of debt outstanding, is if credit spreads widen. And they can widen, but I'd say if they get above 200 basis points on the 10-year. Currently, it's around 164, whereas last week they were 148. So there is some room for the credit spreads to continue to widen, but it would not be catastrophic unless it starts to get above that 200 basis points. So why own this strategy? We believe we use a unique investment process, which helps us not have the same correlation to our benchmarks or our peers. The fund has been very good in the past of avoiding large drawdowns, and the strategy is an attempt to make money in all cycles by following the process. Other different asset classes perform differently at different points in the economic cycle. So on that note, I want to keep this video brief. And if you have any questions, please contact your wholesaler or your inside sales, and we'd be happy to answer any of your questions. Thanks a lot. Bye for now.